Folks, it gives me great pleasure to introduce Vitaly Veksler. Vitaly's been a super fan. He's spoken at a number of my classes, and he's worked at some of the largest banks in the world. And a few years ago, he set up his own investment company, Beyond Borders Investment Strategies. It's a really interesting strategy, very much in line with our philosophy of getting the country right in our emerging markets class. Vitaly, welcome. Thanks so much for being here with us.
Thank you so much, Peter. It's a great pleasure to be here, and I'm happy to share my strategy with everyone in this class. So if you don't mind, let me share my screen. And here we go. Voila. Okay. Thank you once again. My name is Vitaly Veksler, and the name of the company that I represent, that I founded in 2014, is Beyond Borders Investment Strategy. Our motto, global investing using country funds. Just one quick second. So executive overview. The company, it's a boutique investment firm that provides cost-efficient, globally diversified equity strategies aimed at reducing risk and achieving higher risk-adjusted returns over a long time horizon. Usually we try to do it over 3 to 5 years. There are 3 investment goals. One is an investment goal, and then there are 2 impact goals of the company. So the first goal is to increase returns by rotating to countries that trade at low valuations, often during or after crisis, and offer high expected returns. And there are 2 important features that our investors are interested in within this goal. We lower risk by diversifying across multiple country markets and investing in country ETFs rather than individual stocks. And also, we provide more flexibility in determining country position sizes versus broad-based indices. I'll show you during the presentation how important this feature is. While we invest in countries that go through crisis, we also help these countries recover from crisis. So the goal is we help them stabilize, we help companies to start expanding their operations and hiring people, and our goal is to help citizens emerge from crisis. And our second goal is, or second impact goal, is to help to contribute to strengthening global stability and security by reducing militant nationalism that often develops among angry and hungry people in the crisis-stricken countries, and can spill onto the international arena in the form of terrorism or wars. We go through a very difficult time within our country, and you can see how a crisis impacts the mood of people in the streets. And some of the emerging and actually developed countries went through even more difficult crisis. And our style that we use, it's called country value style. And there are 3 characteristics that I would like to talk to you about right away. First, it's a global macro style. We analyze global macroeconomic trends affecting capital flows around the world. And it's a quantimental style, which is part quantitative and part fundamental. So in terms of quantitative part, we identify country indices trading at low valuations and offering high expected returns. We also have to analyze political, economic, legal, business, and technological catalysts and risks for these countries. So it's not enough to look at just quantitative information. in our view. Now, let me briefly talk to you about the reasons for the firm's existence. There are two major reasons. First, we help investors to alleviate their home country bias. As you know, most people are much more comfortable investing within their countries. And when you do this, your returns could be lower than in a global portfolio, and also risks that your portfolio faces, the risks, portfolio risks could be higher. So by globalizing our portfolios, we help increase total portfolio returns and reduce risks. So as you can see from this chart that shows outperformance in the 21st century of the US and global ex-US equity markets, they outperformed during roughly similar time periods. 51 global ex-US equities outperformed for a long period of time. It's 51% of the time. And it's interesting to talk about this because recently US markets outperformed pretty dramatically. And we can say that US markets usually outperform during crisis. Not always, but during crisis, people go to the safe haven markets. But this can change as the world kind of stabilizes. And I will talk to you about this shortly. So, and international diversification can reduce volatility of investment portfolios. It's important to know this. There were multiple studies showing that if you add from 40 to 60% of international exposure to a portfolio, and despite the fact that the international markets are more volatile than the US market, still the volatility of the global portfolio diminishes, and that's very important. So this slide says US stock market cannot outperform forever. As I mentioned, US is considered to be the major safe haven market where investors move from all over the world. They move during crisis. And it could be explained by the fact that the US Federal Reserve is the most powerful of the central banks, and it uses its power to stimulate US economy during crisis. And as you can see that the US stock market, we saw it on the previous slide, outperformed, has been outperforming for the last 11 years. Actually, since it started recovering from the crisis, it has been outperforming. At some point, this will change. We saw that there was a little bit of a switch here. As you can see, the red markets, kind of the global ex-US equities, started to outperform just before we got into the trade war and COVID-19. So at this point, one of the very important characteristic of the market that we are looking at is the US stock market valuations. They are more expensive than valuations of 42 international markets in our universe of 49 country markets. So it means that there is a pressure on the international markets to outperform sometime in the future. We don't know what would be a potential catalyst for the change in the global leadership in terms of performance, stock market performance. But we think that potentially global recovery from global pandemic can be one of them. And also some kind of end to the hostilities or trade war between the US and China, or at least when uncertainty of what the outcome would be, and when business people from all over the world would be able to plan their capital expansions. So that would be the major catalyst, in our opinion. Now, we have two impact goals. As you can see from this chart, on the left, I put together a list of crises that are common crises and that can impact the world. They range from financial crisis to political to geopolitical. And actually, I developed this slide several years ago. And as an afterthought, I put natural disasters and pandemics. And now look at this. We live through one of the most difficult crises that was caused by a pandemic, COVID-19. So what all of these crises have in common, they cause very negative consequences for the societies that they impact. And these consequences could be sharp decrease in investor confidence, dramatic decreases in the stock market prices, which could lead to company bankruptcies and layoffs, increased unemployment, currency depreciation, rapid rise of inflation, and usually all of the crises lead to the sharp decrease in the quality of life, which manifests through higher crime. That's a very common denominator, but also militant nationalism, societal divisions, and sometimes this crisis can spill onto the international arena in terms of terrorism, as we mentioned, or wars. So beyond borders, by infusing capital during or right after this crisis, we are trying to avoid these negative consequences for the countries and for the world. It's very important. There is a list of, I think, 9 or 10 different factors that I put here. We will not be able to go over all of them, but I would say it's important that through investing in ETFs, you can achieve a wide distribution of capital within countries. This distribution is very efficient, and also it's perceived as fair. And let me just briefly talk about these points. First, wide distribution. Unlike stock pickers that often invest in just several companies per country, we can impact the highest number of companies, because when you invest in an ETF, your money goes into at least, I think the lowest number of companies per a single country ETF was 22. So your money goes to at least 22 companies in the country, and in many cases to hundreds and hundreds and hundreds of companies. You achieve the widest distribution of your capital within the country. And when you positively impact not only people who work for these companies, but you also can start an income multiplier effect, which means that you help people who don't work for these companies, but who service people who do work for these companies. You help them to start spending money, and you start a virtuous cycle. And these people outside of the companies would be restaurant owners, taxi drivers, and babysitters. So investing via ETFs, it's a very efficient way of delivering money to countries, because 99% of your money goes into the stocks. For comparison, charities also help countries during crisis, but the ones that spend 65% of their money on the populations that they try to address, they're considered to be the best. You see the difference. Of course, they have a special different niche, but in terms of efficiency, capital markets are super efficient. And also, it's very important, we mentioned that during the crisis, anger and hunger impacts people. They look for all kinds of problems in their societies. And if you invest in one or two companies, even not knowing that, for example, somebody's son or nephew is on the board of this, like a president's son or nephew or niece are on the board of a company, you may be perceived as investing in a corrupt company. We don't want this. It's very important that the weights of companies within an ETF are determined by people who are thousands of miles away, people in MSCI in New York predominantly, and people from FTSE or Financial Times in London. That's a very important characteristic. Now, let's talk briefly about our investment process and features. Let me start with the features first. I'll just cover 3 of them. First, our strategy is a country rotation strategy. We invest in countries around the world, 49 countries, and they move from top 10 to bottom 10 based on such factors as global sentiment and capital flows, economic, financial, and other crises, regional attractiveness, and as we talked before, a very important factor is index valuations and earnings growth. So this chart could be divided into 3 important parts. On the top, there are top 10 countries per year, each year. And in the middle, there are bottom 10 countries. And at the very bottom, there are 3 lines in gray showing the difference between the best performing country each year and worst performing, and then 5th best and 5th worst, and 10th best and 10th worst. And you can see that, for example, in 2019, Russia was the best performing country and Argentina was the worst. And the difference was dramatic. It was 73%. And it was not even the biggest of the differences during the previous years. So to me, it shows that it makes sense to look at country rotation as the strategy. If you manage to find and invest the best countries and avoid the worst, you would be making very attractive returns. This chart also shows that sometimes countries move from the top 10 to the bottom 10 based on, let's say, valuations. I highlighted Ireland. In 2010, it was one of the worst performing markets. In 2011, it went up because valuations were very attractive. Then in 2012, it went back to the worst performing 10 markets. And then in 2013, it went to the top 10. So this is a mechanistic kind of movement. And I wish that we could all forecast all countries. It would have been a very easy exercise if we could forecast that the bottom 10 countries would become top 10 next year. And I highlighted that Brazil, for example, had a very difficult period from 2012 to 2015. It was among the worst performing markets for the whole period of time, when the country was going through a perfect storm, and it had a crisis that was, you know, part economic, part financial, part political, and also medical, with Zika pandemic, with Zika epidemic in Brazil. So the second element of our strategy that is very important is we are value investors. And this chart that I borrowed from JP Morgan shows that if you manage to invest in stock markets that are trading at low valuations, you're more likely to have higher returns in 1 year, and especially in 5 years. You can see that the regression, the explanatory power of the regression on the right is very impressive. It's 42%. 42% of the value differences in performance could be explained by the difference in valuations. This is the chart for S&P 500, but this chart could be used for all other markets around the world. And the importance also, there is one important consideration, that in 1 year, your valuations are not kind of as impactful as they are in 5 years, in subsequent 5 years. And that's because stock market can be impacted by something else, you know, for a 1 year period. But over 5 year period, valuations play an essential role in your returns, future returns. Now, and the last feature of the strategy is that we use country funds as building blocks. We use predominantly single country equity ETFs as building blocks for our portfolios. And I decided to do it this way because I learned a very painful lesson when I just started working for, earlier in my career, I worked for State Street Research and Management. And I was very fortunate to work for one of the best energy equity teams in the United States, not because of me, but because of the people who I joined there. And when we had, at the time, there was a superstar in the global energy universe. It was a Russian company, Yukos Oil Company. It was not just a superstar of the Russian universe. It was not a superstar of emerging market universe. It was one of the companies that was compared to Exxon, which is the most efficient company in the energy industry. Yukos Oil Company used, they had fantastic assets, oil assets, oil fields. Its statements were audited by Western auditing firms, which is a very important consideration for an opaque market as Russia. And the company hired either Western-based, Western-educated, or executive, or the ones who came from the West. There was a lot of learning going on within the company. The company could not do anything wrong for many years. And as you can see from the chart, it outperformed the Russian stock market dramatically. Unfortunately, it all ended very fast. And it ended when the founder of the company and its CEO challenged the Russian authorities. He accused them of taking, tax authorities specifically, he challenged that they take bribes. And sure enough, in 2 months, they came to his office and arrested him and accused him of defrauding the country while he privatized the company, and they nationalized UCOS, nationalized its assets. And as you can see, during the life of UCOS, investors earned a grand total of 0. The CAGR was 0. At the same time, if you invested in the Russian market, which was negatively impacted when the UCOS affair happened, but it recovered and the investors made 15.7%, which is a very impressive number. And when I was thinking about this lesson, I thought that I want to avoid the idiosyncratic risks that often impact companies in the emerging markets. And that's why one of the ways to do it would be to invest using ETFs. So our investment process consists of 4 stages. First, it's a global macro analysis. We research global trends. It's I would say, I described our analysis as quantimental, part quantitative, part fundamental. This part is a little bit more fundamental. We just try to figure out what is the most important driver or drivers for the global markets. Right now it's COVID and recovery from COVID. Then we do our quantitative analysis. We identify countries with low current valuations versus historical averages. And then we calculate expected returns for these countries. And we look at such factors as valuations, growth indicators, and dividends. And when we narrowed our potential investment list to, let's say, a manageable number of countries, we look at specific characteristics such as earnings growth, technical and momentum trends. We look at political reasons, macroeconomic trends, economic reasons, something that could catalyze the valuations to go back to the average and above average levels. And that's how we determine candidates for our portfolios. This chart is a very important one for us. We look at portfolio construction and risk management. And since we invest in countries impacted by crisis, for us, risk management is not just a nice to have feature. It has to be a very important part, the central part of our investment process. So we use at least 5 characteristics. I call them inter-country diversification and intra-country diversification. They help us diversify money that we invest on behalf of our clients. And inter-country diversification factors, there are 2 of them. We diversify our portfolios by investing in 15 to 20 ETFs. We never invest in less than this. And we also, no country position can exceed an annual average of 10% of our portfolio, which is a big difference with the multiple indices, broad-based indices that could invest more than 30% in one country. And we also use 3 intra-country diversification measures. So when we invest, each ETF has at least 22 companies in each one of them, and many have hundreds of companies in them. So the largest company's weight within an ETF cannot exceed 25%. And the sum of weights of all companies represented by more than 5% of the ETF should not exceed and does not exceed 50% of the total ETF assets. And we feel that when we have this diversification within the country and among the countries, we can sleep better at night. So also another very important feature of our investment process is that we're cost efficient. We use ETFs, and as of recently, there are some ETFs that charge just 9 basis points for developed market countries and 19 basis points for emerging market countries. You know, it allows us to develop cost-efficient portfolios. Now, our competitive advantages. I developed this chart. I used to work for bottom stock picking companies, and while they have some advantages, they also have some things that I was surprised, but that's the reality. Everything has advantages and disadvantages. So, for example, our competitors, stock pickers, they may use 40 plus analysts to cover 1,800 stocks that are in an index that we compete against. It's MSCI, All Country World Index ex-US, value weighted. So needless to say that you cannot find 40 people with the same risk tolerance. What is risky for one analyst could be just not risky to another one at all. And when these analysts present their ideas to portfolio managers, it's challenging for the portfolio managers to gauge this level of riskiness that they want to maintain in their portfolios. Also, I've noticed that sometimes loudest and more sociable analysts have disproportionately high weight of their stock ideas in the firm's portfolios. We don't do it. We have only one. We apply the same process to all 48 countries, and clients need to understand just one process. We also offer better diversification than many stock picking colleagues have in their portfolios. And what I've noticed there is that sometimes people invest in just one or two companies per country, and these companies may or may not represent the economy of the country where they're based. And most often, you know, stock pickers, let's say they're sitting here in Boston or in New York, they talk to the managers of companies that had money to travel to the United States. It could be the largest or the second largest company, which may not have the best expected returns. We try to, once again, invest in smaller countries. We can invest up to 10% in each one of them. We don't concentrate on just the largest countries. And we don't give money to one or two companies per country. We invest in at least 22 companies. And I think it's also difficult to pick individual stocks in various countries around the world from one location, because let's say local analysts have an informational edge over you. And I think it's easier to pick countries right, because once again, we use the same process. We're not thinking about whether this company would outperform that company in Egypt, or, you know, what is the best company in Denmark. It's difficult, you know, sitting in Boston to understand, you know, and look at, let's say, close to 50 countries around the world. And our competitive advantages over international indices, as you can see, the chart on the right shows to you weights of largest countries within the index. And as you can see, the top 7 countries are responsible for 60+% of the index. And the remainder, or the remaining 42 countries, are represented by less than 40% of the index's weight. So it's less than 1% per country. So if you're excited about prospects of Peru or Malaysia, or even bigger countries like Russia, you would not be able to get exposure to it, or appropriate exposure, because if you look at this index, if things are not going well in Japan or UK, all your brilliant ideas and their returns would be squashed by the impact of returns in Japan and the UK, the largest countries in this index. And once again, we have flexibility to take positions that are up to 10% of our portfolio in smaller countries as well. And with this, we can probably go over the ETFs if we have time. So, so investment trade examples. We invested in China, and we sold China's ETFs at a profit of 28% in May of 2015, before a major decline of 20% over the next 2 months. And that's a chart that I use for many other countries. We use the Warren Buffett indicator, total market cap to GDP. That's in blue. That's the chart, the line, blue line in the chart. And then we calculate the average for over the previous 8 years. We calculate the average plus 1 standard deviation and average minus 1 standard deviation lines. And when we see that a country is trading at the average minus 1 standard deviation, which is a green line, it's like a green light for our investment. So as you can see, China's ETF was trading close to 1 standard deviation below the average in December of 2013 or January 2014 when we started investing. We invested in it. The biggest fear at the time was that President Xi may privatize state-owned enterprises, but we figured that it's very difficult to change the development model of Chinese economy, and we thought that probably he would not be privatizing all the enterprises within the country, and investors are often afraid of uncertainty. So we decided we would not be deterred. We invested in the stock or ETF of this market, and everything went by the book in a sense that when the investment was close to the red line, which is a red light, and it says to us that 84% of the time this investment vehicle is trading at valuations that are lower than they are now. So we sold this investment, and sure enough, the market collapsed. And I will show you one more chart, which is it's a chart for Egypt. We managed to make money in the Egyptian ETF, but here things didn't go according to the plan necessarily, and that's why this example shows that you have to be aware of not only quantitative measures, but sometimes you have to be aware of what's happening in the country. We sold the ETF after Egypt introduced 2 new taxes on investors, a 10% tax on capital gains and a 10% tax on dividends. And as you can see, the blue line didn't go anywhere close to the red line, right? To the red light. It didn't increase so much, but we had to sell very quickly as soon as we read about these new taxes. So I hope I showed you most of the things about, from the general perspective of what we do at Beyond Borders Investment Strategies. And I hope it was interesting, and would be happy to answer your questions. And thank you.
Vitaly, thanks. And if we're lucky, we'll get to do this live on screen. Thanks again. Really appreciate it.
Thank you so much.